Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, Trump's $1 million gold card equates wealth with extraordinary ability, sparking legal firestorms and threatening America's high-skilled talent pipeline. We'll explore how this shift from merit to capital could dilute America's high-skilled talent pool and reshape the global race for innovation. Second, a billionaire, a CEO, and Truliev's $100 million plus campaign reframes cannabis as pro-business, forcing a policy shift to end punitive 280E taxes. In this episode, we'll break down this new playbook for corporate lobbying and what it signals for industry consolidation and the global cannabis market. Third Alphabet's $93 billion AI capital expenditure spend fuels a 62% stock surge as Gemini dethrones ChatGPT, but a productivity paradox looms. We'll analyse why this user growth creates a monetization challenge and how the persistent productivity gap could affect tech sector valuations. Let's start with a story that's blurring the lines between wealth and talent in America. A new gold card program is offering US residency in record time for a price. The cost? A cool $1 million. Announced by Donald Trump, the program requires a $1 million payment and a $15,000 processing fee. There's also a $2 million corporate gold card for employees and a potential $5 million platinum card with special tax benefits on the horizon. But here's where it gets interesting. The program isn't actually new. It's a fee model laid on top of existing visas, like the EB one, nicknamed the Einstein visa, which was designed for people with extraordinary abilities, think award-winning scientists and acclaimed artists. To grasp the significance of this, you have to understand that the US has traditionally had two very different paths for high-value immigrants. When we place the merit-based EB1 Einstein visa alongside the capital-based EB5 visa, the contradiction becomes clear. The EB1 is based purely on merit, requiring proof of sustained acclaim through awards or significant contributions. The EB5, on the other hand, is about investment, requiring at least $800,000 to create jobs. These two paths, one for talent and one for capital, were designed to be separate. Now, officials say a $1 million payment is itself proof of extraordinary ability. Commerce Secretary Howard Lutnick put it bluntly, asking, why shouldn't we expedite the people who are willing to step up to give the United States $1 million? Let's bring in the top of the top, the best. Why should we take people who are below average, but immigration attorneys are firing back, arguing that a bank account doesn't equal ability? One attorney stated, having $1 million has nothing to do with your value as a person of extraordinary ability. They warn this could allow the wealthy to jump the line, pushing back highly skilled experts, like a leading AI researcher who is already approved but still waiting for a green card. This isn't just about fairness. There are huge economic stakes here. Redefining extraordinary ability from proven skill to sheer wealth threatens to dilute the US. High-skilled talent pool, a leading indicator of innovation. The risk is that it could harm America's long-term competitiveness in critical sectors like AI and biotech by prioritizing capital over demonstrated world-class talent. And the ambitions don't stop there. The administration has talked about raising $1 trillion from the program. But to really understand that $1 trillion figure, it helps to look at the closest comparison we have, the EB5 investor visa program. Research from Invest in the USA shows that between 2016 and 2019, the EB5 program contributed about $184 billion to US GDP and created 1.7 million jobs, a significant number, but it's over 4 years and is less than a fifth of the $1 trillion target. This suggests the figure might be more of a fiscal mirage than a realistic goal. The problem? The visa categories it's built on are capped at just $28,000 per year, with years-long backlogs for countries like India and China. This sets the stage for a massive legal fight, with attorneys warning of lawsuits from those already on the wait list if gold card holders get priority. With questions about non-refundable fees and proof of funds, the program faces significant headwinds. Actually, this significant legal and political uncertainty is acting like what economists call an uncertainty tax. This uncertainty itself is a cost that can suppress demand even more than the fee, chilling private investment. However, if you zoom out, you'll see another layer to this: global competition. For wealthy families, particularly from China, the world is full of golden visa programs. But most of those, like in Greece or Switzerland, are structured as investments that can be recovered. The US Gold Card is a non-refundable payment, a critical difference that could redirect that mobile capital to Europe or Asia instead. So the key indicator to watch here is the Prime International Residential Index. A sudden influx of high net worth individuals could create a concentrated demand shock for luxury real estate in cities like New York and San Francisco. If this program survives its legal challenges, its first real-world impact might be felt not in innovation, but in the housing market. We were just talking about how money is reshaping immigration policy. And speaking of how big money can influence Washington, another industry just scored a major win by reframing its entire public image. A new executive order just eased federal restrictions on marijuana. But the real story isn't the policy. It's how a year-long coordinated campaign by an unlikely trio of power players, a Palm Beach billionaire, the CEO of cannabis giant Trulieve, and the president's own pollster forced it into existence. This wasn't a grassroots movement. It was a targeted push that successfully reframed the debate from a social issue into a pro-business policy. For investors, this signals that corporate lobbying effectiveness and political donations are becoming leading indicators for which industries might see deregulation next. It's a new playbook for so-called vices industries. First, the billionaire Howard Kessler. A longtime friend of the president and a leukemia survivor, he became a relentless advocate. The pressure was so intense that at the signing ceremony, the head of the Centers for Medicare and Medicaid Services, Dr. Mehmet Oz, joked to Kessler, "God bless you for being a pain in our sides." Now get this, Dr. Oz's involvement is monumentally significant. If Medicare were to launch a pilot program for CBD coverage, it would be a revolution. It could transform the cannabis industry from a cash-based out-of-pocket market into a mainstream third-party payer system, just like regular medicine. This would dramatically expand the market and attract conservative institutional capital. The key indicators to watch will be any announcements from CMS about pilot programs. Then came the industry CEO, Kim Rivers of Trulieve. She cultivated access through personal connections and massive spending, reportedly attending a $1 million A-Plate fundraiser. Her company's financial firepower was undeniable. FEC filings show Trulieve donated $750,000 to the inauguration committee and another $250,000 to the MAGA Incorporated Super PAC. For a separate Florida ballot initiative, Trulieve spent over $100 million. And why the enormous spending? After all, these companies are fighting for their financial lives. Under current federal law, specifically a tax rule called Section 280E, state legal cannabis businesses are prohibited from deducting ordinary business expenses like rent and wages. This means they face effective tax rates of 40% to 80%. Easing federal restrictions would eliminate this punitive tax, making the return on these lobbying investments massive. Finally, the pollster, Tony Fabrizio, provided the data. His firm ran a poll paid for by a cannabis-backed super PAC showing broad voter support for reform. The president himself cited this data during the signing. The campaign was so effective that President Trump admitted, "I've never been inundated by so many people as I have about reclassifying marijuana." But the end game here is about more than just new regulations. The pollster's own son, a cannabis industry CEO, compares the future of the industry to Standard Oil. That analogy is powerful because it reframes the entire long-term investment thesis beyond just consumer products. It suggests a second wave of industrial growth in materials like hempcrete and bioplastics, making R&D spending on hemp-based materials a key leading indicator to watch. What really brings this to a head is the next step. Federal reclassification is expected to trigger a massive industry consolidation. The end of the punitive 280E tax code and the opening of interstate commerce will separate the operationally excellent firms from the rest. And this isn't just a domestic US story. An unshackled US cannabis industry could leverage its superior capital markets and agricultural scale to outcompete Canadian and European rivals, potentially reshaping the entire global supply chain. From a $100 million lobbying campaign to a $93 billion capital expenditure, the sheer scale of investment in today's corporate battles is staggering. And that brings us to the war for AI dominance. Just months ago, Alphabet's stock was in a freefall, plunging 18% in its worst quarter since 2022 amid fears it was losing the AI race. Today, the stock is up 62%, outperforming all of its mega cap peers. This is a full-blown counterattack spearheaded by a relatively unknown executive named Josh Woodward. His playbook, especially around Gemini, is what's flipped sentiment on Wall Street. The core conflict is Google versus OpenAI. For a while, it looked like Google was on the ropes, but then came the Gemini app. In a stunning reversal, Gemini dethroned OpenAI's ChatGPT from the top of Apple's App Store, with its monthly active users exploding from 350 million to 650 million in just over 6 months. This explosive user growth presents a fascinating duality. On one side, it's a clear win in the user war against OpenAI. On the other, it exposes a deep challenge to Google's core business model. Search advertising. AI agents accelerate the trend of zero-click searches, forcing Google to figure out how to make money in a world where users might not need to click on ad-supported links anymore. One feature, an image generator called Nano Banana, became so popular it generated over 5 billion images and nearly crippled Google's infrastructure. In an internal meeting, Google's head of AI infrastructure said, quote, "Our TPUs almost melted." Believe it or not, that quote about TPUs is incredibly significant. TPUs, or tensor processing units, are Google's own custom-designed AI chips. So the thing is, by developing its own proprietary silicon, Google is building a strategic moat, reducing its dependence on the global supply chain and giving it a hardware advantage that's hard to copy. This surge is the result of a deliberate high-stakes strategy. Alphabet is now pouring a jaw-dropping $93 billion into capital expenditures this year. And that $93 billion, it's more than just a line item on a balance sheet. This massive spending, along with similar investments from Microsoft, Meta, and Amazon, is creating what's known as an AI capital expenditure supercycle. According to research firm TrendForce, this spending is so large it's significantly boosting US economic growth figures, potentially masking weakness in other parts of the economy. Inside Google, Woodward is credited with cutting through bureaucracy by empowering engineers with a simple philosophy: let them cook. And that philosophy, it's more than just a catchy phrase. It points to a critical, non-financial indicator for investors: innovation, velocity. In the fast-moving AI race, organizational agility may be as important as R&D spending. But here's the billion-dollar question sophisticated investors are still asking: where is the productivity boom? Despite rapid AI adoption, the expected surge in national labour productivity hasn't appeared in the economic data, recalling the famous Solow paradox. This gap between technology adoption and productivity statistics is a classic setup for valuation risk. Google CEO Sundar Pichai recently told employees, "The momentum has been incredible to see. We've been shipping at a pretty fast pace across the company." Looking ahead, the narrative splits into two paths. For investors, the immediate focus will be the quarterly earnings reports from Google and its competitors, paying close attention to any commentary on monetizing these new services. But for the broader economy, the real story is in the US productivity data. A sustained uptick, there would be the first real sign that the AI revolution is translating into broad economic gains. If it remains flat, it could force a reevaluation of the current high valuations across the tech sector.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.